Hey folks, this is Colby Valenta with Valenta Capital Management with an educational economic update for February 2019. In this month's video, I'll discuss some of the major headlines that influence markets in January, and I'll also provide a little bit of insight into what these developments could mean for you as an individual investor. As always, please stay tuned at the end of this video for a lovely required disclosure statement that we need to read aloud to make sure that the attorneys and the regulators are happy. All right, so January 2019 is behind us, and man, what a difference 1 month makes. By the end of 2018, the S&P 500, Dow, and NASDAQ posted their largest annual declines in years. In fact, the S&P 500 and Dow experienced their worst December results since 1931. Fast forward a month and the momentum has swung in the opposite direction. The S&P 500 added 7.9% and the Dow was up 7.2%. These gains mean that both indices had their best January performance in at least 30 years. NASDAQ didn't do bad either. That increased 9.2% last month, which was its best January since 2001. These gains occurred despite the longest government shutdown in history continuing for most of the month. So the question is, why did markets rebound in January? A few details helped change investor sentiment, including Federal Reserve comments and corporate earnings season. In December, concerns about how quickly the Fed was raising interest rates contributed to market declines. But by January, Fed officials indicated several times that the central bank would begin taking a more dovish view. The Fed also chose to not raise interest rates after its most recent session, saying they're going to be patient on deciding on future increases. Market confidence grew, knowing that the Fed's not rushing too soon to hike rates again. Corporate earnings season also largely affected performance in the markets. By January's end, about half of the S&P 500 had released their fourth quarter results. That data reinforced that corporate growth had slowed later in 2018, offering no new surprise. Instead of driving market losses, however, January's earnings releases contributed to market growth. Well, why? This happened in part because a few solid reports from large companies helped ease investors' worries about a potential recession. In February, the remainder of corporate earnings season is ahead. Both global growth and the ongoing trade discussions between the U.S. and China may also remain on investors' minds. Furthermore, we should receive some delayed data which was postponed by the government shutdown, which includes the first reading of fourth quarter gross domestic product, or GDP. In the weeks to come, we're going to be monitoring these and a multitude of other details, and we really do look forward to sharing these perspectives with you as they pop up and arise. So that's it for our quick overview of January 2019 and the educational economic update. Once again, this is Colby Valenta with Valenta Capital Management, signing off for the month of February 2019. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 303-951-5975. We would love and be more than happy to chat with you. Now for these lovely required disclosure statements that we need to read. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in the periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results. Thanks.